Hi, I'm Steve Decker with IPX1031, and thank you for spending a few minutes with me to discuss the current taxes that you are able to defer by utilizing a 1031 exchange. Now, normally when I sit down with a customer, I always ask them, I say, why are you using an exchange? And probably 95% of them tell me that they want to do a 1031 exchange because they don't want to pay a boatload of taxes back to the government. So that tends to beg the question, what taxes am I able to defer by utilizing a 1031 exchange? Well, currently there are up to 4 different taxes that you can defer by using a 1031 exchange to your benefit. The first is long-term capital gains tax. So anytime you own a piece of investment real estate and you've held it for more than 1 year, you would pay long-term capital gains tax on the gain that you have made when you sell the piece of real estate. So if you just decided to sell your real estate and cash out, you would be giving either 15% of your gain or 20% of the gain back to the federal government in the form of long-term capital gains tax. Now, just be aware that the long-term capital gains tax threshold adjusts for inflation each and every year. So keep an eye on that for the next time that you sell one of your investment properties. Now, if that's not bad enough, there are also 41 states that have some level of state income tax. Now, I'm going to use my home state as the example. I have the fortune, or the misfortune, of living in the state with the highest ordinary income tax of any state in the country. That's California. So if you owned a property or you are a resident of California and you decided to sell your property and cash out and just pay your taxes, you could expect to give another 9.3 to 13.3% of your gain back to the state as well. Now, if that's not bad enough, there is also a healthcare surtax, sometimes referred to as the net investment income tax. This tax came into play in 2012. Now, what the heck does healthcare have to do with real estate? I don't have any idea. But when we reformed healthcare back in 2012, the federal government had to find a way to pay for healthcare reform. So they decided to tax investments, and investment real estate is included in that. So if your adjusted gross income is above $200,000 a year if you are single, or $250,000 if you are married and filing a joint tax return, you get the pleasure of giving an extra 3.8% of your gain back to the government in the form of a healthcare tax. And last but not least is what I refer to as the hidden tax. This is the kicker, the one that my customers tend to forget about. Anytime you own investment real estate, you should be taking a depreciation deduction on your taxes. Now, there is a caveat to this. If you own vacant land, you cannot depreciate the vacant land. But if you own a single family home, a condo, a townhouse, a triplex, or you own anything that is commercial real estate, you should be taking a depreciation deduction on your taxes each and every year. Well, if you just decide to sell your property, do your civic duty, and pay your taxes, the government comes back and says, hey, you know all that depreciation that you took over the last 10 years that you've owned this property? Well, I want 25% of that back. So depreciation is recaptured at a rate of 25%. So the long story short is that when you combine or blend all of these rates together, the Fed, the state, the healthcare, and the depreciation, you are generally looking at giving on the low end 20% of your gain back to the government. On the high end, it could be upwards of 41, 42%, depending on what state you sold in as well. If you're coming out of a high income tax state like California, New York, New Jersey, Minnesota, or Hawaii, this rate could get pretty high. So a lot of our customers use 1031 exchanges as a way to defer paying all of these taxes. For more information, feel free to give me a call or send me an email. And thank you for your time today.